Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by Oppenheimer Funds. Oppenheimer Funds has nearly 50 years of experience investing beyond borders to find tomorrow's opportunities. Find out more at oppenheimerfunds.com/global. This week on the podcast, Rowe Price's year of fund upgrades, tips for Medicare open enrollment, Baird's Tim Steffen discusses year-end tax planning, Alec Lucas analyzes this world large stock option, Aron Szaprio on the implications of the midterm elections for investors, and dividends in the cereal aisle. Let's get started. Here's Russ Kinnell on upgrades at Rowe Price this year.
From Morningstar, I'm Jeremy Glazer. Rowe Price has had the most upgrades of any fund family this year, and I'm here with Russ Kinnell. He's our Director of Manager Research to look at some of the themes that have led to these upgrades. Russ, thanks for joining me.
Glad to be here.
So let's take a look at Rowe over the last 12 months. They've had 10 upgrades and only 3 downgrades. When you look across these upgrades, what stands out to you as the reason that we're more excited about some of these strategies?
Yeah, I think we're seeing an older generation of managers retire, and we're becoming more comfortable with the newer generation. I think Rowe has done a really good job of filling both its analyst and portfolio manager bench, so that when you see these transitions, generally they work really nicely at Rowe, not just from a style consistency standpoint, but from an execution standpoint. And so as we get to know these managers, we've been upgrading a lot of funds. We visit them every year, and I think just really impressive effort across the board at Rowe.
What are some of the strategies that we've upgraded?
We upgraded Rowe QM, Quantitative Small Growth, which is a quant small growth fund that we've been covering for a while now, but just been gradually more and more impressed with how it's performed. So most recently moved it from silver to gold.
Another upgrade to gold was Rowe Price Blue Chip Growth. What's the story here?
Yeah, Larry Pooley has been running the fund since '93, so obviously there's no big change there, but just as we become more comfortable with the analysts supporting the fund, but also the fact that this fund, without taking on excessive risk, is one of the few large growth funds that's continued to beat the Russell 1000 growth. So really impressive performance in up markets and down markets. So just gradually, it just made a very strong case for gold.
On the negative side, though, there have been some downgrades. Rowe Price New Income, in particular, is now neutral. What gives you less confidence in this strategy?
Yeah, manager Dan Shackelford is set to retire in 2019, and there have also been some sector shifts going on at Rowe, sector team shifts on the fixed income group that give us pause, and so we lowered that fund from bronze to neutral.
Russ, thanks for the update on Rowe today.
You're welcome.
From Morningstar, I'm Jeremy Glazer. Thanks for watching.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, Mark Miller offers tips during Medicare open enrollment season.
Hi, I'm Christine Benz from Morningstar.com. Medicare open enrollment runs through December 7th. Joining me to discuss what goes on during open enrollment and what you should be looking for is Mark Miller. He's a Morningstar.com contributor. Mark, thank you so much for being here.
Hi, Christine.
Mark, let's talk about what open enrollment is. What are the specific items that people are shopping for?
For people who are enrolled in Medicare, this is the time of year when you can make changes in your coverage. So you can either change either in or out of traditional fee-for-service Medicare and Medicare Advantage. That's kind of choice one.
Okay.
And then you can also make changes in a standalone prescription drug plan, Medicare Part D. Those are and you would be doing that probably only if you're in traditional Medicare, because most Medicare Advantage plans, not all, have the prescription drug coverage baked into it.
Okay.
So that's the basic thing people can do this time of year.
So you always urge retirees who are enrolled in Medicare to reshop their coverage. Let's talk about why you think that's important to do at this time of year.
Well, because the plans can change from year to year. The premiums can change, the out-of-pockets can change, what's covered can change, the provider networks can change. So just assuming that because it was good for you last year, that it will continue to be good for you next year is not always a safe assumption. That's the basic reason.
And you can save yourself some money, potentially.
You can definitely save yourself some money.
Okay. So let's talk about that first fork in the road, the Medicare Advantage versus traditional Medicare. This is your opportunity to make a switch there, right?
Yes. Yes. So Traditional Medicare, I always say, is sort of the gold standard, and from the standpoint of flexibility of providers. Almost all healthcare providers take your traditional Medicare card. With Medicare Advantage, there may be some money-saving opportunities because the plans roll together a bunch of different services. So, for example, I mentioned prescription drug is often rolled in at no extra cost. Lots of them have vision coverage. A number of them provide some level of dental insurance, which, by the way, may be a topic for another day, but traditional Medicare does not really cover most dentistry services.
And a huge surprise cost for a lot of retiree households.
Indeed it is.
Yeah.
So the trade-off, though, with Medicare Advantage is that they're typically either HMO or PPO, meaning that you must use in-network providers in order to get the most advantageous services. And so, that can be an issue. I think Medicare Advantage works really well for younger, healthier seniors. The issue that comes up, let's say you're in the middle of the plan year, and something really serious comes up, and you want to see the top specialist in your town on whatever this is, and that person may or may not be in your plan. So it's the typical trade-off of managed care, really. Even
though Medicare might be the gold standard, traditional Medicare, you're still going to have to bolt on some additional coverage, though, right?
That's, I think a lot of people perceive as a downside of traditional is there's more moving parts, where Medicare Advantage is kind of all-in-one coverage. Here you're going to have your basic coverage of Medicare Part A and B. You're probably also adding a prescription drug plan, Part D. And many people also buy a Medigap insurance plan, which is you're referencing, supplemental coverage that caps your out-of-pocket expenses and really can smooth out variations in your health spending in a very meaningful way. The sticking point that's relevant to open enrollment on Medigap is this. If you want to move out of Medicare Advantage into traditional Medicare, and you're already several years down the pike in terms of being on Medicare, you've missed the best opportunity to buy Medigap. The best opportunity to buy Medigap is when you first enroll, because there's an open enrollment period at that time, and the insurers cannot do so-called medical underwriting, meaning charge you more because of a health condition or even turn you away for coverage. So you can make this switch at that, several years into the road or whenever, but know that you may have more challenges with Medigap, either paying more or even being turned away depending on health status.
Okay. So in terms of trends that you see when you look at the Medicare Advantage plans, when you look at open enrollment for 2019, let's talk about that.
A Medicare Advantage?
Yes.
Well, one thing that people may have heard about is that Medicare Advantage plans are now starting to experiment with a new class of services that relate to things like home care. Adult care at home and the like. There's a whole raft of these services, which I detail in the column on Morningstar.com that it kind of goes with this discussion we're having. And the key thing to know about that is most plans have not rolled out new services this year because the new rules on this just came out in the spring. So probably see more of that in 2020.
Okay.
The other interesting change, I think it's a small one, but could be important for some people, is that there's a kind of a do-over period that runs from January to the end of March. If you enroll in a Medicare Advantage plan that you don't like for some reason, you can make a change during this do-over period. And it's also been expanded a bit, and that you can now also move it back into traditional Medicare if you like during that period.
Okay.
So those, I think, are the key new things to know about Medicare Advantage.
Okay. So moving on to the Part D, the prescription drug coverage.
Right.
This is another option. This would be something for people who are covered by traditional Medicare. It's their time to review their coverage and decide if they want to switch insurance plans. Let's talk about the virtue of doing that, and more importantly, how to do it, assuming that I'm confronted with this choice.
Right. So what you find is there's 10 plans that basically are most of the market. And when you look at what's going on with the projected premiums for next year, you see that it's kind of all over the map. The overall weighted average increase in premiums for Part D drug plans next year is only expected to go up 2%. But nobody's average, and people are enrolled in specific plans.
Right.
So the important thing to do is to look at your plan. And when you look at the top 10 for next year, the projection is that 5 of them will have substantial increases, 5% to 10% even. 3 of them will go down a bit, and there are 2 that'll be unchanged. There are also changes to the deductible structures in some of them. The basic point is you got to take a look at your own plan. Don't just read that somebody wrote, oh, costs are only going up 2% next year. That may or may not be your situation. So you really got to take a look. Everybody gets in the mail what's called the annual notice of change, that these arrived back in September, that detail any of these changes to your plan that you're enrolled in. So take a close look at that, and if it looks like there's a substantial increase that you're not happy about, you go on the Medicare Plan Finder at medicare.gov, and you can run a search to see what might be better options for you. You'll plug in your Medicare number plus your specific prescriptions, and the site does a good job of sifting through and showing what might be good fit plans for you.
Okay, that's good advice. Let's talk about a little bit of good news that came to retirees in terms of the cost of living adjustment that Social Security recipients will get. I'd also like to discuss Medicare premiums in that context, the Part B premiums. And
they're related because in most cases, the Medicare Part B premium is deducted from your Social Security benefit. So the good news is that we're going to see the highest cost of living adjustment since 2012 next year for seniors. It's the cost of living adjustment will be 2.8%. The last time it was anywhere this close was 3.6 in 2012. These are set by a formula under federal law that's tied to the cost of living in the consumer price index.
Right. So I guess the bad news is that there are higher costs coming online.
Inflation is higher.
Yeah,
and,
right.
And it's coming through in the form of the COLA. Equally good news is that we won't know the Part B premium for next year until probably a little later this year, but it was projected earlier this year by the Medicare trustees to only be going up $1.50 to $135.50. So
a month.
Yes, a month. Thank you. And so that means that, in short, most seniors will get to keep most of the COLA next year, which is great.
Thank you, Mark. It's always great to get your perspective.
Thanks for having me, Christine.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Baird's Tim Steffen discusses year-end tax planning.
For Morningstar, I'm Jeremy Glazer. As we're well into the fourth quarter, many investors are thinking about year-end tax planning. I'm here today with Tim Steffen. He's the Director of Advanced Planning at Baird to look at some topics here. Tim, thanks for joining me.
Thanks, Jeremy.
So my first question for you is looking at your tax return for next year, first year of the new tax laws. Should investors really expect to see a big difference in their refund next year?
The studies are showing that all things being equal from one year to the next, the vast majority of taxpayers are going to see a reduction in their total tax liability. There'll be some who break even. There'll be a small percentage who will pay more because of the level of their income and some of the deductions they claim. But most people, on a total basis, are going to pay less tax. Where they might be a little surprised is when they get their final bottom line number in their tax return. What's their refund? What's their balance due? That may be different than what they expect. The reason being is that a lot of these tax cuts that were enacted this year were already paid back to taxpayers via lower withholding tables. Remember earlier in the year, the withholding tables were all changed and people noticed my take-home income's gone up a little bit because they're not withholding as much tax. Well, that was the benefit of your tax cut right there. So when you go to file your return, the refund you've gotten in prior years may not be the same refund you're used to getting, or you may end up actually owing a little bit more than what you think. And again, not that your liability's gone up, but your payments went up as well, or went down, and so the bottom line's gonna be a little different for folks this year than what they might expect.
Oftentimes, tax experts recommend accelerating deductions, deferring income as much as possible. Is there anything in the new tax law that changes that? Should you be thinking about that differently towards the end of the year?
Yeah, last year that was certainly the case. At the end of 2017, unfortunately, we didn't have a lot of time to react to that because it all happened so late in the year. For 2018, as we compare 2018 to 2019, at this point anyways, it doesn't look like there's going to be anything substantially different. That could change. You see what happens with the midterms and all this other stuff. But assuming 18 and 19 tax laws are the same, then the old standby, as you said, defer income, accelerate deductions probably makes sense. The exception to that would be if your own personal situation changes. So if If you're retiring, or not if you're retiring, let's say your income is expected to jump up next year for whatever reason. Maybe your deductions are more valuable to you next year, so you push those out into next year. But for most people whose income is pretty consistent from year to year, accelerate deductions into this year, defer income into next year to the extent you have the ability to do that.
Let's think about property taxes. There was a scramble at the end of last year to prepay as much as possible. Anything this year that should be on your radar when it comes to property taxes?
You know, the issue there last year was the new limit on state and local tax deductions. So that's $10,000 hard and fast ceiling on that. If you're getting to the $10,000 already because of your income tax withholding for your state, there's no rush necessarily to accelerate your property taxes into this year, nor is there any reason to maybe accelerate next year's into this year. Not all states have the ability to do that. We're either in Wisconsin, we can, but a lot of other states can't. So you may just have to pay them as the bill comes. If you have the ability to time them, then you need to talk with your tax advisor to figure out what makes sense. In most cases, there probably won't be a big advantage to accelerating or deferring. You just kind of pay them each year as they come due. You do want to take a look, though. Some states offer incentives for the property taxes you pay that year. So you want to make sure you've got something paid every year as opposed to maybe having a year where there isn't any. You may lose out on a state incentive then in that case.
How about medical deductions? Any changes in that front?
Again, medical expenses is another one of those where you might have some flexibility in timing when you pay those expenses. You don't have a lot there, but you might have some. One of the things that is scheduled to change for 2019 is medical expenses will be harder to deduct next year. Right now, you can deduct medical expenses if they exceed 7.5% of your income. Next year, that's scheduled to go to 10%, which means all things being equal, medical expenses will be harder to deduct next year. So there may be an incentive for moving them into this year. Now, that could all change. That may go back to 7.5%. We probably won't know that until late 2019. That's how these things tend to work. Or if your income is going to be lower next year, 10% of a lower number might make it easier to deduct those expenses next year anyway. So in general, you're better this year, but your situation might dictate that that's the opposite.
Turning to investments, even with the volatility we've seen, you might still be sitting on quite a few gains. Anything that you can do to try to limit any sort of tax burden there?
So a few things we talk to folks about. One is if you've realized some gains already this year, which you may have done, now may be the time to harvest some losses in the portfolio to offset some of those gains. If you want to get back into the position, be careful about the wash sale rules. That 30-day period, you've got to wait to buy back in. But there may be some opportunity to net losses against gains. If you've got new money that you're looking to invest, you may want to be careful as we get closer to the end of the year about buying into mutual funds. As they get towards the end of the year, they tend to pay out their capital gain distributions for the whole course of the year. You might buy into a fund just before it pays out the capital gains for the whole year, and then you're stuck paying tax and all that. So as we get closer to year end, maybe be careful about new investments in funds and wait until those payouts are made. Other than that, when it comes to investment income, we really talk to folks about managing the portfolio in a way that doesn't generate income you don't need. So for example, if you're not living off your portfolio, you don't need dividends and interest, maybe avoid investments that create dividends and interest because you don't want to pay tax on income you don't need.
Anything else you should have in mind as the year ends?
So year end is a great kind of bellwether. It's the time that reminds you of everything else that you should be doing at this time of year. So we talk about things like review beneficiary designations on your retirement or plans or your life insurance. Update your estate plans if there's been a birth or a death in the family, a marriage or a divorce. Maybe you move to a new state. So take a look at the estate documents and update those. Look at your asset allocation. This is a great time to go back and update all those passwords you've got for online. In the era of cybersecurity, the more often you can refresh those passwords, the safer you'll be. So a lot of those kind of things we talk about this time of year.
Tim, thank you.
Thanks, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
This podcast is brought to you by Oppenheimer Funds. Oppenheimer Funds has nearly 50 years of experience investing beyond borders to find tomorrow's opportunities. Find out more at oppenheimerfunds.com/global. Next, Alec Lucas analyzes gold-rated American Fund's new perspective.
Gold-rated American Fund's new perspective is one of the most reliable options in the world large stock Morningstar category. Since its 1973 inception, the fund is focused on companies benefiting from changing global trade patterns and navigated various protectionist measures along the way. Regardless of market climate, American's multi-manager system sets up this fund for success. Other than sticking to companies that receive at least 25% of their revenues from outside their home region and have at least a $3 billion market cap float at the time of purchase, this fund's 7 named managers are free to run their separate sleeves of the overall portfolio in line with their own styles. The fund's portfolio stays grounded in multinational blue chips, but it isn't lacking in aggressive picks, as the presence of Tesla attests. Since entering the portfolio in early 2015, Tesla's struggles to turn a profit have led it to be more than 3 times as volatile as the MSCI All Country World Index. Yet thanks to this fund's globally diversified portfolio, the fund itself has hardly missed a beat and maintains a superior record over the long and short term.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Now, what a Democratic House means for investors.
For Morningstar, I'm Jeremy Glazer. After yesterday's election, the Democrats are set to take control of the House in January, while the Republicans will increase their Senate majority. I'm here with Aron Szaprio. He's our Director of Policy Research. We'll talk about what this could mean for investors. Aron, thanks for joining me.
Oh, thanks so much for having me.
Now that we have divided government, is it safe to say that we're not going to see any big legislative changes? What do you think some of the priorities of House Democrats will be?
Well, I think people don't need to turn to Morningstar to know there's going to be a big focus on investigations, not just of President Trump from the House Democrats, but also of his cabinet and kind of the routine oversight that you expect in any situation where there's divided government. So I don't think we're going too far out on the limb to say that's going to be a focus. But I think there might also be some interest in doing bipartisan legislation around making some tune-ups to the retirement system, making it easier for people to save for their future. So we'll certainly be looking for that as well.
If investigations really do take center stage, is that something investors should be following closely? Is it going to have a big impact, or is it really more of a political story?
Well, I think investors should be following it very closely in their role as citizens. But in their as they think about their investments, it would really be a mistake to overreact to any of the kind of daily drips of information we get about the investigations. Let's think back to when Robert Mueller was appointed special counsel. Markets went down in response to that news, and they quickly rebounded. And the reason is that there's just not that much day-to-day connection between investigations and the business of governing. And a lot of the agencies that make policy that directly affect investors, like the Securities and Exchange Commission, are really quite independent and somewhat insulated from these kind of day-to-day machinations. So I would say investors should stick to their strategy and not worry too much about the kind of day-to-day information on investigations or the tweets back and forth or whatever else. We don't need to. I think there are other sources of information that you can turn to, and they all kind of agree it's going to be perhaps pretty ugly politically, but I don't think that should change anybody's investment strategy.
Let's talk about some of those policy proposals you mentioned. There could be some bipartisan work around retirement. What are some of those that are on your radar right now?
Yeah, so there's a couple of things that have had broad bipartisan support, but haven't quite had the support to get through. One thing is letting small plans band together in order to offer, or small employers band together in order to offer a retirement plan and sort of use their greater assets under management for leverage to get a better deal for their participants. So this is an idea with bipartisan support. And I think if it doesn't happen in lame duck, one name you're going to hear a lot of in the next session is going to be Richard Neals. He's taking over as the chair of House Ways and Means. That's the tax writing committee in the House. And of course, most of the way we encourage retirement savings flows through the tax code. So he's very interested in these kind of ideas. So that's one thing. Another kind of, fine-tuning idea would be making it easier for people to access longevity protection inside their 401k plans. That's an idea with a lot of bipartisan support that just hasn't quite had a champion. So again, I think we'll see likely some movement on some of these, again, kind of fine-tuning ideas. Now, speaking of Representative Neal, he's proposed much bigger overhauls of the retirement system, and I would expect to at least see those get some traction on the House side. Obviously, they may not get, go through the Senate and become law, but I think you'll see some fine-tuning of those ideas. A big one, for example, would be a auto 401k bill that he proposed a couple of months ago that would essentially require many more employers to offer some kind of a 401k. I think there's some issues there that need to be worked out to make sure that these new 401ks, which wouldn't have, as they're currently structured, a match requirement, make sure they wouldn't cannibalize existing plans. But that's an important idea. And one thing that might not quite be on many investors' radars, but has occurred to me as the night was unfolding, is Democratic governors have been trying to expand access to retirement plans for people who don't have coverage at work with these auto IRA programs. Obviously, we saw a bunch of Democrats pick up governorships last night, so I suspect we'll see some of those proposals emerging in new states as well.
Looking at the Senate, does that larger Republican majority there open up any opportunities for legislation that maybe had been stymied there before, or would you expect the status quo?
I don't think it makes a huge difference. I mean, it makes a big difference politically, of course, but and going into the next election cycle. But in terms of legislation, I mean, the magic number in the Senate is really 40, where you kind of lose the ability to filibuster. And, in a divided government situation, that's not even that important. I actually think the most important thing we should look for in the Senate is who's going to take over Orrin Hatch's role as chairman of Senate Finance. There's sort of rumors there. I'll leave those to other websites. But once we know, we'll do some analysis on what his or her track record is and what kind of proposals we might see and how they would affect ordinary investors. But that's a big change that's going to happen there, and the sort of an important committee from the perspective of sort of an ordinary person saving for retirement or other goals.
Other than Senate Finance, what else are you going to be looking for the next couple of months to get a sense of what we could see early next year?
Yeah, I mean, I think it'll be really interesting in January, where those first wave of bills from the committee chairman come out, and we'll get a lot more clarity then. I think that the sort of range of possibilities is from again, fine-tuning to fairly big proposals that may not make it through this session, but kind of set the stage in the future. And I guess the other thing, everybody always has to mention infrastructure. Everybody always says, well, there could be a deal on infrastructure. We've been hearing that for some time, so I'm a little skeptical. But if there were, that would, there were a big infrastructure bill that was able to find purchase in the House and get through the Senate, that would first of all signal a much more bipartisan style of governing than I think is generally the common wisdom, and would probably provide a fairly meaningful short-term stimulus and long-term help for the economy. So that's something to keep an eye on. But I don't think it's a hugely likely probability.
Aron, thank you for your analysis this morning.
Thanks so much.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
And finally, we look at the dividends from General Mills and Kellogg.
While sales and consumption growth in the cereal aisle has languished over the past few years, we think investors would be well served to indulge on the shares of the leading manufacturers in the space, namely Widemote, General Mills, and Kellogg, both of which we view as undervalued. For one, we think the market's confidence in General Mills' ability to restore top-line growth has faltered, considering continued softness in volume across the industry, as well as skepticism around the acquisition of natural pet food company Blue Buffalo earlier this year. While the deal carries some inherent risk, as General Mills enters a category in which it has limited experience, we remain confident in the firm's ability to efficiently integrate Blue Buffalo and extract cost synergies from combining these operations, as we expect it will lean on the experience gained when it added Annie's and others to its mix, leveraging its supply chain and distribution capabilities while largely leaving the acquired firm's operating model intact. Further, we don't surmise its hunger for deals will compromise its ability to return cash to shareholders. We model a dividend payout ratio averaging 65% over our 10-year explicit forecast, which is in line with its 5-year historical average, and implies mid-single-digit dividend growth. Given its discounted price, trading about 25% below our $58 fair value estimate, And with a 4% plus dividend yield, we think the stock provides a sufficient margin of safety for long-term investors. Further, we suggest investors with an appetite for income should give Kellogg a look, as it boasts a dividend yield of more than 3%. Kellogg's position as a leader in the U.S. cereal aisle, holding more than 1/3 share of the domestic ready-to-eat cereal space, combined with efforts to bolster its position in the on-trend snacking category, which now accounts for more than half of its total sales base, up from just 1/4 at the start of the century, makes it a valued partner for retailers. From our vantage point, Kellogg's decision to pivot away from direct store distribution, which had accounted for about 1/4 of its U.S. business, and transition completely to a warehouse model, has been a prudent means to free up resources to invest further behind its brands in terms of innovation, marketing, and new packaging, and ultimately support its entrenched relationship with retailers, which we believe is a pillar of its intangible asset-based wide moat. As such, with shares trading around a nearly 15% discount to our valuation, combined with our expectations for mid-single-digit annual growth in its dividend over our explicit forecast horizon, we think investors would be wise to keep this wide moat name on their radar screens.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.